And I would like to have a look at how that looks in the general ledger account. So if you look at the general ledger account of the ordinary shares in Jabulani Limited, you will see that we make use of many columns. It is not necessary that you do it this way. You could have like a normal T account, only the amount and the information on the debit side and the amount and the information on the credit side. You don't need to do those extra columns that we have here, price per share and number of shares. The reason we do it all together in one T account, it just makes it easier to manage and to keep your head around it. But you are welcome to just show the amount, not these extra columns that you don't usually see in a T account. But then every amount would have to have a separate calculation underneath the T account. So it's just easier to show everything and all the columns together in one T account. So we start with 1 January, the balance, and we have already said that the R1.95 would be the fair value that was there at the end of the prior reporting period. We have 4,000 shares there, for the amount in our shares account is 7,800. Then on 1 February, we acquired additional 2,000 shares. So we would say debit this T account, debit the asset, the ordinary shares. Your credit would be to bank because you paid for it in cash. How many shares did you acquire? You acquired 2,000 additional shares. What did you pay for them? The fair value that they were trading at was R2.10. This excluded the brokerage, and it is correct for the category at fair value through profit and loss that we exclude the brokerage, because the brokerage is an expense immediately through profit and loss. So we would like to have the fair value here just for the shares, excluding any brokerage, and that is what the R2.10 was. So after that transaction, if you want to, you can do a balance carried forward. You don't have to do it. It just makes our next transaction easier in the T account. So you would see I have a balance carried forward and brought down on the 1st of April, which is the date that something else happened. So what happened on the 1st of April? Well, if we go back to the given information, they say Jabulani Limited had a capitalization issue of 1 ordinary share for every 4 ordinary shares held on 25 March 2021. Immediately prior to the capitalization issue, the shares of Jabulani Limited had a fair value of R2.15 each. Arnu Limited chose to do a fair value adjustment immediately prior to recognizing the shares from the capitalization issue. So we need to just stop and pause here and talk about what a capitalization issue is. So let's think about that from Jabulani Limited's point of view. So Jabulani Limited might want to give its shareholders some sort of return, but maybe they don't have enough cash to pay out a dividend. They therefore decide what they are going to give their existing shareholders as a return on that investment in their shares. They will give them a capitalization issue. What does that mean? It means you give your existing shareholders more shares. So you need to have enough authorized share capital to be able to do that. But if you do, you can give existing shareholders more shares, and it happens in a ratio. It happens in some sort of ratio to how many existing shares they had. And they told this to us. They said Jabulani Limited had a capitalization issue of 1 ordinary share for every 4 ordinary shares held. So every single shareholder, for every 4 shares that they had, they will get an additional 1 ordinary share for free. They don't have to buy it. They get it for free just because they are a shareholder of Jabulani Limited. What will Jabulani Limited recognize in their own accounting records? Well, they would need to recognize something in their share capital column. In your statement of changes in equity and in your SFP, under share capital, you have issued more shares. So credit share capital. What is the debit entry? You didn't sell those shares, so you can't debit bank. You gave those shares to existing shareholders. You gave those shares for free. You can't debit bank. You didn't receive any money. So with a capitalization issue, you take one of your reserves and you make it capital. That's where the word capitalization comes from. So we usually use our distributable reserves, and specifically we usually use retained earnings. And you take an amount out of retained earnings to share capital. So you capitalize, make capital a part of your retained earnings. So Jabulani Limited would need to have a look, what are the shares worth? What is the fair value? How many shares are they issuing? And calculate the amount that they would take out of their retained earnings into their share capital. So that is in the books of the issuer, Jabulani Limited, the company that gave more shares in terms of a caps issue. Now, what happens in the books of the investor? In this case, Arno Limited. Arno Limited, the investor, the shareholder, will get more shares for free. Just because they are an existing shareholder, just because they have existing shares, for every 4 existing shares that they have, they will get another 1 ordinary share for free. They don't have to pay for that. So, in terms of the rules of IFRS 9 financial instruments, all financial instruments are always, day one, recognized at fair value. So those shares that Arno Limited gets, they will recognize at fair value as part of their investment in shares account. So you get more shares, you would say debit investment in shares, you would use the fair value as the measurement. What is the credit entry? Well, the credit entry is a gain on a capitalization issue. You received shares for free. It's like a donation that you received. So the credit is gain from capitalization issue. And that gain will be grouped together in the end with all the fair value adjustments that you do for these shares, for the investment in the shares of Jabulani Limited, because your fair value of your investment changed because you got more shares for free in terms of the capitalization issue. Now, in this example, Arno Limited chose to do a fair value adjustment on their investment just before recognizing the capitalization issue. You do not have to do a fair value adjustment at that point. So, in a question, I will need to tell you, do they choose to do it or not? It is not necessary to do a fair value adjustment immediately before recognizing a caps issue. But in the category at fair value through profit and loss, the entity can do fair value adjustments every single day if they wanted to. They could do a fair value adjustment every day to the fair value of the shares on that day. There are certain dates where it's compulsory, where you have no choice, where you have to do a fair value adjustment. But on any other day, you could choose to do a fair value adjustment, as they did in this case. So this entity chose to do a fair value adjustment just before recognizing the capitalization issue. So we would need to go and have a look, how did they calculate the amount of the fair value adjustment? This is done in calculation number 1, where we have a look what the fair value is just before the capitalization issue, and we compare that to what the balance in the investment T account is at that moment. So they tell you that the fair value just before the caps issue is R2.15 per share. We have 4,000 original shares plus the 2,000 we acquired during this year. So you would have to calculate what the fair value of the total 6,000 shares are. Compare that to your balance in the T account. What is currently your balance in the investment in ordinary shares T account? And the difference is a movement from your current balance to the fair value. This could be a positive movement, an upwards movement like the case here. So you would say debit investment, credit fair value adjustment, or it could be a negative, a downwards movement. The fair value decreased. Any movement, whether it's upwards or downwards, any fair value adjustment goes through profit or loss, because that is the category we are in. It is therefore either income or an expense. Now we can also calculate how many shares do we receive in terms of the capitalization issue. Currently, we have 6,000 shares. The ratio of the capitalization issue is that you get 1 new share for every 4 existing shares that you have. So in terms of this capitalization issue, we will get an additional 1,500 shares. Those 1,500 shares will be recognized on day 1 at fair value. Remember our rules for financial instruments. All financial instruments are always on day 1 recognized at fair value, which in this case is R2.15.